Right, good morning, afternoon, and good evening to everyone. Just giving everyone a chance to see everyone coming in to the room now. Welcome back to the Trading Vault. If we could also, just as always, if we could just please do a quick audio visual check, make sure that you can hear me okay. And you should be able to see my screen, which says the webinar will start shortly. Let me move that on as the webinar has now started. So it should say the Trading Vault. And then today we're going to talk about trend trading strategies. So, as always, that's why we give people a couple of minutes just to come into the session. Introduce yourselves, let us know where you're coming from, and also sort of like the level of experience that you've got. As always, towards the end of the session or at the end of the session, we would ask you just to remain on and answer a short survey, which will allow us to basically tailor the content in future sessions to what you want to see from these and give you exactly what it is you would like to get from these sessions. So um, we've got people here from Norway, Malaysia. Hi, Denise from Essex. I know you're a regular today, so great to see you here again. Indonesia. Um, from the UK, started in October, so very new. Okay, cool. Yeah, good to have you here, Matt. Hope the trading is going well so far, and you're learning a lot. It's a very steep learning curve trading, but hopefully it's going well. And hopefully these sessions can give you a lot of information as well. We've got Zambia, okay, so Africa represented here, Philippines, more from the UK, great stuff. Cool. Right. Okay. So let's see what the time is. Yeah, we're a couple of minutes in. So let's sort of start with this session. So um as always, ask questions as we go through the session. I'll try and address the questions that are asked as we go through, and then we'll have a bit of a Q&A at the end as well. So if it's relevant right there, then I'll answer it straight away. If not, I'll come back to them at the end. And if I do miss any, then I do apologize. It's not through intent. It would just be an oversight. So if I have missed any, then please do feel free to post a question back in at the end of the session when we're doing the sort of Q&A. But today we're going to talk about trend trading strategies. So there's been a lot of requests for strategies on the feedback forms from at the end of the session from the surveys, and today we're going to cover sort of like one very simple sort of more mechanical style strategy, and then we're going to talk about breakouts, how to identify breakouts when we're in a trend, and then the best way that we can get in on those as well. And then in a couple of weeks' time, we're going to talk about reversal strategies to give you some opportunities and identify some strategies in sort of more range bound markets, and we want to use the information from the session, one of the first sessions that we did on impulsive and corrective price action, to be able to identify when we're in an impulsive move, when we want to be identifying these sort of trend trading strategies. And then we also want to identify when we're in a more corrective phase, and that's when we're going to use the reversal strategies that we're going to cover sort of in a couple of weeks' time in the next session. So, first of all, just a quick introduction to myself. My name is Ross Maxwell. I'm VT Markets Global Operations Strategy Lead. I provide high-level educational content for traders of all levels and all experience. That's right from new beginners just starting out right the way through to experienced traders looking to improve and become more successful. I'm also a professional trader and investment manager myself, and I've been trading for more than 20 years. So I have more than 20 years experience trading the markets, with a career. I started in London. It took me to Hong Kong, and then I've been now trading as an independent trader for the last decade, or just over 10 years now. I'm also an award-winning trading coach and mentor, and the founder of a company called Key Zone Traders, which is an online trading education company. So, as I say, today is all about trading the trend. So you've probably heard the phrase, the trend is your friend. And when we're beginning, it's probably easier to trade these sort of trend trading strategies. It does require a lot of patience because markets do not trend as much as they are in a corrective phase. Trends are normally for a shorter amount of time. than they are in a corrective phase. So we have to be patient. We have to wait for them. We can use multiple markets to identify different opportunities. But ultimately, it's the easier one to trade because price action is normally a bit cleaner. The opportunities are there. We can, we have the retracements are a lot shallower. So it's just a lot easier to trade, and obviously the reward opportunities are much greater. So, we can have a much lower success rate in our trading and still be profitable and have an edge because we can make more money on our winners than we do on our losers. So trading with the trend, if we can identify a trend in the market, we should be looking to trade with that trend as much as possible. So if we have identified an impulsive move, we're going to cover that impulsive move again in a moment and the characteristics of it. But if we've identified an impulsive move and we've identified that we're in a trend in a particular market on a particular instrument, we want to trade with that trend. We do not want to trade against the trend because you're opening yourself up to losses. You've got to time the top or the bottom of that trend perfectly, and that is very, very difficult to do. So as I say, the trend is your friend, and you do not want to fight against the overall trend in the market, because we can get better reward to risk trades by trading with that trend. So if we've identified an uptrend, we only want to be looking to buy the market, and if we identify a downward trend, we only really want to be selling the market. We want to be looking for sell opportunities. So again, we're just going to cover these impulsive moves. So we're going to use the information from that impulsive corrective session, which was one of the very first sessions that we covered in this series of the trading ball. What we do is we use it to identify when a market is moving into a trending phase. We can identify very early when we're moving into a trending phase, so we can then start taking advantage of that trend, start looking for those trend trading strategies and those trend trading opportunities. So what are a reminder of the characteristics of an impulsive move? Well, the candles are of the same color. So they'll be bullish, again, depending on what color you have your candles set at, but they'll be of the same color and moving in the same direction. They will close at the bottom if we're moving in a downtrend, and they will close at the top if we're moving in an uptrend. So we want to look, and by the top, I mean sort of like the top 20-25% of the candle, or the bottom 20-25% of the candle, depending on which way the market is moving. They generally will be larger than the average size candle. There will be little overlap between the candles. So generally speaking, the market will open, and if we're moving an uptrend, they will just continue up. There won't be like a big overlap of the candles moving down. They will just generally open and continue in that way. And we're going to look at a graph and a chart in a minute to show this. Retracements are generally held by the moving averages, so that's the 8 and the 20 moving average. And actually the 20 moving average is going to be one of the indicators that we're going to use for the simple trend trading strategy that we're going to talk about today. And also the moving averages that I noticed I put the EMAs, that's the exponential moving averages, they're the ones I personally use. If you use a smooth moving average or just a general moving average or something like that, then it's okay. Like, the differences are not going to be too different. It's just through personal choices. I use the exponential moving average. We want them to be pointing in the direction of the trend, and we want to see them starting to separate and move away from each other. That's the 8 moving away from the 20. Okay, and here is an example of that trend. So you can see the retracements are held by the moving averages. We've got move up, pull back, move up, pull back. This is a very strong trending market. You can see all of the candles are generally of the same color. Like, I'd sit there and say sort of good 80-90% of those candles are all pointing upwards and moving up. They're all bullish candles, and there's not a lot of overlap. There is some overlap in a couple of them, but generally speaking, there's very little overlap. We've got a little pullback here. The moving averages, and again, this is how we can identify very early in the trend. So the market moves down here. You can see the market moves above here. You can start to see this is the 8 moving average. The blue line is the 8 moving average. The yellow line is the 20 moving average. And you can see here that the moving averages starting to separate away from each other and pointing in the direction of the trend. So once we see this early on down here, this is when we can start to see those trend trade. We can start to identify those trend trading strategies, and that's when we want to start to look to implement them into our trading plans and into our actual execution. Okay, so any questions on that, guys, from the start? Otherwise, we can move on and we can start looking at the actual strategies and a little bit more about identifying how to identify when we want to be trading with that trend. So no questions coming through so far. 820 is independent of the time frame. Yeah, the 8 and the 20 is fine. Gula, that's so depending on what time frame. Again, you know, these strategies can be used on any time frame. So the 8 and the 20, whether you're trading, like you might be more of a higher time frame trader using the daily charts, it's exactly the same concept, exactly the same mechanics, exactly the same theory as to if you're trading off of like a 5-minute chart and you're more of a day trader. So yeah, you can use the 8 and the 20 independent of the time frame that you're looking to trade. So Uh, so Tariq, as I say, I use the 8 and the 20 moving average. That's my experience. There's again, people can use slight hybrids of that, but they're the ones that I use. I'm glad I pronounced the name correctly as well. So the two moving averages are the 8 exponential moving average and a 20 exponential moving average. So one thing that we want to look for, and as well, so a lot of people I think overcomplicate this process, and this is higher time frame context because we want to, when we're trend trading or when we're trying to trade with the trend, we want to establish our bias and identify a trend on a higher time frame chart. And a lot of people use this sort of top-down analysis, and they look at 3, 4, 5 different time frames to try and establish the trend. But the problem is if you're on a 5-minute chart, the overall trend on the weekly chart or the daily chart may be something completely different, and you're going to miss a lot of opportunities, or you're going to create this sort of analysis paralysis, and you're never going to be able to identify the trends. You're always going to be creating this confusion in your mind. So what I suggest is we want to establish a bias and identify a trend on the higher time frame chart and move to a lower time frame chart for execution. So we only need to look at one higher time frame chart for context and one lower time frame chart for execution. So decide on what time frame you're going to execute your trades on. So decide on what type of trader you are, what sort of time frame like you're going to trade on and you're going to execute on, and then you just move up one time frame for the higher time frame context. Now, again, this isn't a hard and fast sort of this is what you should do. This is more of a guideline for certainly the new traders, the beginning traders here. Use this as a guideline to identify what you should be looking at for the higher time frame context. So if you're trading on that sort of lower time frame charts, with that 1 to 5 minute chart, you can use the 1 hour chart for your higher time frame context. If your execution is on the 15-minute chart, you want to be using at least the 1 hour, maybe but I would advise maybe the 4 hour chart as your higher time frame context. So again, you identify the higher time frame, you identify the context on the 4 hour, and then you execute on the 15-minute chart. On the 1 hour, you want to be using a 4 hour, but preferably a daily chart. And if your execution is on the 4 hour, you want to use the daily, but preferably the weekly chart for higher time frame context. And again, if your execution is on the daily, you want to use the weekly, but potentially the monthly chart for your higher time frame context. So you're just moving up some time frames just to make sure that you get the right context. If you look at 2 or 3, you're going to see conflicting information. You're going to create this analysis paralysis, and you're going to make mistakes. So this isn't, and remember as well. So if you're just using one higher time frame context and one execution time frame, you're not going to get it right all of the time, but you're going to get it right more of the time than if you're creating this sort of analysis paralysis and creating confusion in your own mind about making the decisions that you want to in your trading. So it's about making a clear plan and creating an edge. It's not about getting it right every time, and that's just what I think people try and do by layering in too many time frames. Is they're trying to create this perfect scenario, this perfect picture of exactly where the market is at the moment and how to attack it, which unfortunately doesn't exist. And what we're actually trying to achieve as traders is just to try and create the edge. So simplifying it means that we create that, we transfer that simplicity into our trading. It doesn't mean we'll say we're going to get it right all the time. It transfers the simplicity into our trading, and therefore it's a clearer plan of what we're trying to do. So if you're trading off the 30-minute chart, you should use the 1 hour for higher time frame. No, you shouldn't use the 1 hour. I would say for the 30-minute, you probably want to be using maybe a 4-hour chart for your higher time frame context. Okay, so chart pattern and strategy. So looking at the actual strategy now that we're going to use, a very simple strategy. We're going to look at the mechanics of the strategy and how we can implement that into our trading. So the strategy that we're going to look at is called a moving average continuation strategy. Okay, so once we've established a trend on the higher time frame, we can move to our execution time frame to actually execute the strategy. We know from the impulsive session that a trend holds the moving averages on retest. We've seen that just now in the execution that we used, or the example that we used. And the moving average continuation is a simple strategy to take advantage of trends in the market, as it uses the pullbacks to the 20 EMA to get into that trend. Okay, so this is a very, very simple strategy that we can use in the markets to identify easy ways to get into that trend. Okay, so let's look at the basic concept and the basic rules of this strategy. So we want to see that strong impulsive move in one direction with clear separation between the 8 and the 20 moving averages. We're going to look at this on the chart again as well with actual examples. Okay, we then want to see a corrective pullback and a retracement to the 20 moving average, not the 8. We want to see the pullback to the 20 moving average. Okay, once we've connected with that 20 moving average, we want to look for a signal candle. So just because we connect with that moving average doesn't mean to say we just enter there. We then, once we've connected with it, we now want to look for a signal candle. If price continues below the 20 moving average, then the trend may be over and we should not be trading. So again, we want to, if the price moves back to the 20 moving average and continues lower, we do not want to be trading that because it would suggest that our trend is a lot weaker now and the trend may be over. Okay, so this is what we're starting to look for. Okay, so you can see we've got a period of sideways action, very, very sort of corrective sideways action. The moving averages are very horizontal. There's not clear separation. Price is moving, oscillating back and forth. So there's no clear trend in the market. But also notice that, again, we've got this sort of like very much mixture of candles. We've got lots of wicks on show, all of the characteristics which show a corrective phase. Very early on in this sort of in this phase here, in this part of the market. Okay, this is a euro dollar 5-minute chart. So say for example we've identified that we're in a downward trend, so we're looking for sells on the euro dollar. We move to the 5-minute chart. We start to see this sort of impulsive move here. So notice that 20 moving average, which is the blue line, the 8 moving average, which is the yellow line, they're starting to separate and move away. Okay, so price starts trending, creating that impulsive structure, starts holding that 8 moving average on retests here. So we move down, 8 moving average, retest, down, 8 moving average, holds it down, holds it down. Then we start to move back to the 20 moving average, pull back to the 20 moving average and connect with that moving average at this point here. Okay, so what does a signal candle look like? Any questions? Is that all clear? If we just move back 1 second, one to here, is that clear? We've got the corrective phase where we don't want to be looking for trend trading strategies. So we've identified on the higher time frame contracts that we're in a down, that we've got a bearish bias, so we're looking for sells. We move here. We don't want to be trend trading here because we're not in a trend trading market on our execution time frame. And then we start to see this here, this separation, so we can now look to take part of that trend. We've got the characteristics of the impulsive move, and then we were looking for this move back to the 20 moving average where we get to test it here, and then we're looking for our signal candle. Does that make sense to everyone? Perfect, good stuff. So, a couple of questions coming here. If using supply demand, is the execution 1 to 5 minutes? Is the 15-minute chart okay? Yes, yeah, I think 15-minute is the lowest you would want to go, Hugo. 15-minute, 30-minute, or the 1 hour would probably be fine. You don't, if you're trading, basically you don't on the one. If you're executing on the, if you're executing on the one, definitely sort of the 15 is probably okay. 5, I would suggest maybe the 30 or the 1 hour. But basically, what I'm trying to sit there and say is, you don't want to be trading off the 1 hour, 1 minute or 5 minute time frame and looking at a weekly chart for your high time frame context, because the two charts are so separated. They're so disjointed that you're not really getting the right information that you need. You want to be keeping it far enough away that you're seeing that higher time frame overall picture, but not too close to it as well. So hopefully that makes sense. Would it be wise to combine MACD and RSI? Lorenzo, so personally, I don't look at MACD and RSI. I think let's focus on this particular strategy at the moment. We can talk about MACD, RSI strategies in future sessions, but I think let's keep this one very simple for now. What is the so moving average name in TradingView will just be an exponential moving average or moving average, and select the exponential option. Yes, Sidip, this does work in gold as well. So with that, best to sell under the. I wouldn't say you need to sell under the 8 moving average. We're going to cover what this signal candle is now and how we can enter into this trade, Gerardo. Okay, so let's go through the actual signal candle, the concept of it now, and the actual parameters to enter this trade, and what we're looking for the signal candle. So you could look for specific candle patterns to get into the trade. So once you've moved back to that moving average, like you could be looking for an engulfing candle or pin bar, or you could just be looking for some form of, in this case, a negative candle, something that shows that the sellers have stepped back in again. Again, this could be a candle moving back, like closing back on its lows, something like that. But ultimately, as this is a trend trading strategy, we want to see some form of momentum candle. That's some sort of larger candle closing on its lows, so that we can take it shows that the sellers have stepped back in to try and take advantage of continuing the trend. So if we've identified an uptrend, we should be looking for the candle to be closing within 20 to 25% of its highs. And if we've identified a downtrend, as we're going to look at in this example, we want it to be closing within 20 to 25% of its lows. The closer to the highs or the closer to the lows of that signal candle, the better. You can, as I say, you can look for a specific pattern. That could be, you know, a pin bar, a negative pin bar. It could be an engulfing candle. It could be sort of like a 1, 2, 3 candle where we get 3 lower lows off that candle before we enter the trade. You could be looking for that sort of close and break below the 8 moving average that Gerardo you mentioned. So you sort of like wait for the price action to close below that 8 moving average before you enter the trade. I think by the thing to notice on that, or the thing to take note on that, is if you're looking for one specific candle pattern, or you're looking for one, if you're going to look for a specific candle pattern, you're going to be taking a lot less trades, because not every single continuation will set up with a pin bar, or it won't necessarily set up with an engulfing candle. And also, if you wait for the market to move back below the 8 moving averages and then get into the trade, yes, that's an absolutely fine way to look at trading it, but you're going to reduce your reward to risk potential. So yes, you're going to miss a lot losers, or you're going to miss some losers, but your reward to risk is going to be lower as well. So just things to consider. That's not to sit there and say you shouldn't do either any of those. It's just things to consider when you're developing your trade plan around how you're going to trade this strategy. We're going to look at just the basic principles of it, which is looking for another momentum candle in the direction of the trend that we have identified. So entry for this would be a break of the candle in the direction of the trend. So you want it sort of 1 to 2 pips, and again, we're going to use this example, going to as a sell, we're going to enter 1 to 2 pips below the low of the candle, and your stop would be a break in the opposite direction of the candle. So it would be 1 to 2 pips above the high of the candle. So your entry is 1 to 2 pips below the low of the candle, and your stop is 1 to 2 pips above the high of the candle. Your target can be the next zone. We spoke about zones again in previous sessions, looking at that supply and demand, or some people use fair value gaps, those sorts of things. You can look for something like that to use as your target. And you can leave what you want to do as well as you want to manage scale out of your trade. So close portions of your trade as you go along and leave portions of your trade to run to higher targets, because this is going to maximize your reward potential on these trades. We should be getting a minimum of 1 hour out of these trades from the very outset. So the distance to your first target, that be your first zone of resistance or support, should be at least 1 hour in comparison to what you're risking. Okay, but our overall potential on this should be looking for multiple R trades, because they are with the trend and we're looking to take advantage of that momentum. So is that clear in terms of what we're looking for in terms of the signal candle and how we would enter and exit that trade? Any questions on that at the moment? What is electronic and regular trading? So Sudip, I'm not too sure what you mean by that. If you're talking about what's the difference between like an EA, like electronic algorithm, so that's sort of like you set up some sort of pre-coded system, pre-coded trading system to just you press start and it with the parameters that you want to trade, and it does it for you and executes for you. And a regular trading session would be a manual trading session. If I'm understanding that correctly, I'm not 100% sure if I'm understanding that question correctly, but that would be my perception of that. Yeah, so this again, this sort of strategy works on all asset classes, all time frames. So crypto, stocks, uh, gold, oil, commodities, Forex. Would volume data also give you a signal in conjunction with EMAs? Yes, if you want to use volume as something. So again, if you have lower volume on the pullback to the moving averages, and then that signal candles give you a higher volume, that's another good signal to add weight to the signal. Yeah, you could set up an auto trader for this strategy. I'm sure it's a fairly simple strategy, right? So I'm sure you could set something up. I don't have it myself, but I'm sure that would be something that if you can code strategies, then it would be a very simple strategy to code. But as I say, that's not something that I deal with here. Okay, so again, this is exactly the same chart that we was looking at before. So we've got that impulsive move down, we've got a pullback to the moving averages, and then this candle here becomes the signal candle, because you can see it closes on its lows. You want it closing back below, at least below that moving average, that 20 moving average. If it closes back above that 20 moving average, you do not want to be taking that trade. You want to see that trend being held by that moving average and the close back below that moving average. So this candle becomes the signal candle. So you have your stop, sorry, your entry, just a break. You can see one or two. So the low is here just around 117.0950. So we'd have a entry around 117.08, so point and a half below the low, and your stop is sort of 1.5 points above the high of the candle at 117.16. And you can see this market moves lower, 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 lower. You had a potential for 5R in this trade from that high, from entry there to the lower. Now, like I say, this is very easy, and a lot of people sit there and sort of say you could have made 5R in this trade. This is in hindsight seeing the potential reward on this trade. So you want to be scaling out and taking profits along the way. So maybe at one reward to risk, you take out 50% of your profits to make the trade risk free. And then you can use a trailing stop for the other portion. So you may just like trail it above the candles, and you'd probably end up exiting here, which would not be a huge risk reward potential. Or you may look at something like trailing it above the 8 moving average, where you would actually come out above down here. So this is sort of like you could probably exit above that candle here. That's a close and break back above that moving average. And that looks to me probably about 3 to 4R risk to reward there. So you can you can start scaling out, but use that runner, and then maybe even take more portions of the trade as you go along to lock in those profits. Okay, so we're going to use that. There's different options that you can use, whether it's a scaling out at sort of 1R, 2R with a total target of 3 or 4R. You can use this moving average as a barrier and have a stop on a close and break above it, or you can just use a simple sort of trailing stop. So again, there's no real right or wrong here. I'm just giving you the options that are available to you when managing these trades. And it's up to you to sort of like decide which one suits you and your profile best. Personally, what I tend to do is I scale out and I look to target the zones of support and resistance that I've got in front of that trade to lock in my profits. Okay, so any questions? A couple of questions coming through here. There are 2 sessions in stock like NASDAQ. What I usually do, unlock the high, the low of the day in the electronic trading session and try to find that support near the daily low and resistance near the daily high. And I switch to regular trading session for my execution. What thing can I do to enhance the strategy? So, okay, so Sudip, that sounds to me a bit more like a reversal type strategy. And we're going to talk about reversal strategies in the next session. I just want to focus on trend trading strategies for today. So, Carissa, for the trading stop loss, there's different ways that you can do it. Okay, so if you're using a pure trailing stop loss, you can do this. So this is an 8 pip stop. Okay, so you've got 117.08 to 117.16. That is an 8 pip stop. Now you can do different things. You can use an 8 pip trailing stop. So every time the market moves down 8 pips, your stop will move down 8 pips. So as soon as the market moves 1-to-1 moves down 8 pips, your stop will move down to your entry. It moves down another 8 pips. It will move down to 8 pips below that. So like 117.00. And it will just, every time the market moves, whatever your trading stop is, the stop will move down that number of pips as well. Okay, so every time it moves 1R, you move your stop loss moves down, you lock in 1R, an extra 1R of profit. Or you can use trailing stops above the candle. So every time the candle moves down, you move it above that candle. Personally, I don't like that one at all. I think because, markets do not move down in straight lines. So you can see here, you would actually get stopped out very, very quickly and you lose out on all of this potential profit. The other way to trail is, like I say, use the moving averages to trail your stop. You could use the 8 moving average. So you just wait for the market to close back above the 8 moving average, and then you close it out. So you would close it out down here because that's where it closes back above the 8 moving average. Or you could do wait until it closes back above the 20 moving average, which is up here. So I know here in this instance you would have reduced your reward because it's higher than it closing above the 8 moving average. But if this had then continued lower, you could have maybe even got some more profit out of it. So there's different ways that you can do it. And maybe I can go into more detail about trading stops in another session and the different ways that we can do it. Hope that gives you some clarity, Carissa. So for Rick, if the candle breaks the 20 EMA, but a few candles later it comes back and closes below the 20 EMA, can we still consider it to short after the... You can do. Again, this is something... I think you want it to close back below the moving averages, and you want to see the moving averages still... because obviously if the 8 moving averages started to move back above the 20, then, the trend is probably over. You don't really want it, and also if the more candles that are above the 20 moving average, it's just showing that the trend is not really that strong because the sellers are not continuing to step in as strongly. So I would probably prefer not to in this case. I think you want the best strategy, or the best trades that you're going to take in this strategy would be the ones that connect with that 20 moving average and then close back below it almost straight away. Denise, trading stop loss costs money. Yes, like I say, in depending on how you use it, especially the aggressive stop losses, I personally think can take away a lot of reward potential in some of the bigger trades. So Emmanuel says, why do I always place your pending orders on the 1 hour time frame? And secondly, how do we know the exact place to place the pending orders, especially in a market with too many zones? Okay, so this is going back to a previous session, so I won't cover to spend too much time on it, Emmanuel, if that's okay. 1 hour is purely my uh, execution time frame of choice. Okay, again, there's no right or wrong. Sometimes I actually execute on the I place my orders on a 4 hour time frame. It's just through choice. Okay, it fits with the holding times and the style of trading that I want to do. If you want to trade it on the daily, if you want to trade it on the 5 minute, it's exactly the same. But I personally, just through personal choice, execute on the 1 hour. Um, so we've got the 20 moving average, and the other is the 8 moving average, Hector. Okay, so let's move on because there is something in the example you gave on the momentum candle. How confident are you it will continue that downtrend and doesn't move up like the previous candle? It's not about being confident or unconfident. It's just about playing the probabilities. So we're again, I'm confident that the moving that we've entered a trend here. I'm confident we've entered an impulsive move. I'm confident that we've come back and connected with the 20 moving average, and then we've seen a momentum candle to the downside. Sometimes it is going to trigger us in reverse and take us out. Okay, so it's not about being confident in terms of this not doing that. It's about being confident in the characteristics and the strategy playing out and having an edge that the more often times than not, this will continue. And actually, as I said earlier on, you've got 5R potential here. Even if you're taking profits along the way, you can book a good sort of 2 to 3R profit on this trade. Now, if you've got a 3R trade, okay, and you're right 30% of the time, you're going to be making money on on your trades, okay? Because you make 3R 30% of the time, so that's 90%, and you're going to lose 30%. You make 60% profit overall. It's like it's just a simple math. So it's not about being confident. It's just about being confident in having a clear plan and being confident in that plan to create the edge. Okay, so Mark, it's the 8 moving average and the 20 moving average. And I use the exponential, but as I said, smooth moving average, normal moving average is fine. They're just going to give slightly different signals. Okay, so let's move on, guys, because I'm aware that we've got 20 minutes and there is some other things I would really like to cover here. So we're gonna cover this in the next session as well about identifying false breakouts. Okay, but I want to talk about how we can identify a potential or the characteristics of a breakout which is going to have a higher probability of being a true breakout. Okay, because being able to identify a genuine breakout can stop us from falling victim to being to being a victim of false breaks. And we're actually going to talk in the next session about identifying false breaks, and rather than falling victim to them, actually profiting from them as well. So this is going to allow us to prepare for our trade ahead of time so that we are ready, and it will allow us to get us into better quality of trades. Now, what does a pre-breakout structure look like when it's got a high probability of actually being a true breakout? We need to identify a clear area of support or resistance. So there's going to be multiple touches of that support or resistance zone, which we need at least 2, but ideally we want 3 or more. The reactions from the zone should be getting weaker. So what it's almost doing is that, again, if we've got an area of resistance and the reactions are getting weaker, it means that the buyers are stepping in more aggressively, or that this selling pressure is not being able to push the buyers away as again. So if we just again think about it from that sort of like an imagery point of view, it just shows that the buyers are continuing and the sellers can't push them back, so the buyers are still in control. So, and potentially that 20 moving average could be carrying price into the zone. Not always, but that's one way to look at it. As again, what I say is it shows that the pushbacks from the other side are getting weaker, and the side that is dominant and trending still has control of the market. So we're going to look at this example here. You can see here we've got a first touch, we've got a second touch, and notice we've got this sort of like upward trending sort of zone of support, and you can see we've got a touch here, pushes higher, second touch, push back, higher series of higher lows, another touch, push back, another higher low before we then break out. So it's sort of like this compressing of price action moving into that zone. So the zone of resistance remains clean. You can see here that the resistance zone is very clean. It holds very well, but the pushbacks are less. They're creating a series of higher lows. Okay, so hopefully that that is quite clear. This just goes to, this is what you're trying to look for when you're looking to identify a pre-breakout structure. So again, I'm not sitting there saying you want to jump in straight away, because what often happens is people identify this and they start wanting to just like jump in as soon as this structure breaks, and that's when they get called out. Because actually, if you think about it, and if you take that second touch and you just enter on a break above that second touch, you could actually enter here, and then you've got a losing trade. But what it does do is it allows you to, by identifying this structure, you can then go, right, okay, we've got a potential for a true breakout, a real breakout coming up on the chart. And then once we see that breakout, we can then look to get into the trade, because we've got a higher probability that this is going to be a true breakout. Okay, so we're now going to look at breakout retest, because again, what I find happens when people want to try to trade breakouts is they're so scared of missing out on the move that they try and jump into that breakout too aggressively, and they get they open up themselves to more false breaks and more losing trades. Okay, so this is the way that I trade breakouts. I wait for a retest of the breakout area, because I know that price is attracted to liquidity, and it gives me a higher probability trade setup. Yes, I do miss some moves. Okay, it's not every single trade, not every single breakout will retest the breakout area, but I know that more often than not it does. And if I wait for that retest, I give myself a higher probability trade. I give myself a better chance of making money, which is what we are in trading for. So, as I say, traders often jump into breakouts for the fear of missing out on a trade. So it's an emotional decision. It's an emotional response rather than one made from sound logic. Okay, they often get caught and fall victim to liquidity grabs and false breaks, which, as I keep saying, we're going to cover in the next session of the Trading Vault, where we're going to actually show you ways that you can take advantage and profit from these liquidity grabs and false breaks rather than fall victim to them. So as I say, we know price is attracted to areas of previous liquidity, and there is a good chance that once price breaks out, it will often retest that area at some point. Again, not always, but more often than not. So rather than jumping into a trade for fear of missing out on a trend, we need to exercise patience. So don't let the emotion dictate our trading decision. We can then enter into the trend even if we've missed an entry on the initial breakout, because it gives us clear entry and stop placements with good risk to reward trades, and it protects us from false breaks and liquidity grabs. Not all the time, but just protects us more often than not from these sort of false breaks and liquidity grabs. Okay. So what do we need to see for this? So we want to see an impulsive breakout above a strong zone of resistance or below a strong zone of support. So we want to see that pre-breakout structure and then an impulsive break through that structure. Okay. Then we want to see a corrective pullback into the previous zone, which should now act as support if it was resistance previously, and vice versa. So it should act as resistance if it was support previously. We can look to our trade plans for an entry technique or chart pattern, and again, we can use the continuation pattern that we've just spoken about if the moving averages are moving in with it, or we can use reversal patterns, which we'll cover in the session in a couple of weeks time, or any pattern that makes up your trading plan. That is what the entry technique will be once we get the retest from the zone of liquidity. A more advanced way, and I often do this, is by using those limit orders and knowledge of identifying zones from the previous session that we spoke about and covered in the trading vault to establish entry, stops, and targets. So let's look at that example. So this is exactly the same trade that we had a look at before. We've got that pre-breakout structure. Okay, we've got this zone of resistance with the second, third, and fourth touches. We've got these series of higher lows, and then we've got this impulsive break through that zone. So two really strong candles before retracing correctively. And this is a corrective retrace because notice that it takes 1, 2, 3, 4, 5 candles to retrace back to the zone, to which takes out just that one and like half this other candle. So like 1.5, 5 candles to take out 1.5 candles worth of price action. Okay. Now this is a Euro Yen 4-hour chart. Okay, so again, if you're using this as a higher time frame context chart, you could look for that, and then you could move to a lower time frame for your execution. So you could look at a 1-hour chart to then start trying to identify strategies. So you could execute off the 4-hour, or you could move down to your 1-hour chart to execute using a candlestick pattern. Me personally, I would use a limit order at the top of this zone. So you just enter at the top of that zone as a buy order, and you would have your stops below the zone of support, and you can target the next zone above. Okay, so you can see that price retests the zone and then it continues the trend higher. Okay, it's a great opportunity to get long from this zone because we know price is attracted to previous areas of liquidity. So we've got this pre-breakout structure. Okay, again, we're not acting on it, we're just identifying it as an opportunity that there is likely to be a true breakout coming up. Now this is a 4-hour chart, so again, you're looking at this, you've got like a couple of days worth of price action to prepare for this. Okay, then you break out, you see this is 8 hours, again, plenty of time. So now you know, right, so you've got, right, I can see the pre-breakout structure, I can see that we've broken out impulsively. Now you can start making decisions about, okay, if we pull back to this area of liquidity correctively, what does my trade plan say? Do I enter my limit order? Do I look for an entry on the 4-hour time frame, or do I move down a time frame and look for my execution on a lower time frame? And again, you then got 20 hours worth of you've got 20 hours of time to actually prepare your trade. Okay, because you've identified the trend, you've identified the correct price action. Now you're planning your trade. You've got plenty of time to do so, to actually get that right and execute before you then take advantage of this move up. Okay, that's it, guys. That is the way that some simple ways that we can look to get into trends once we've identified trends, price action that we're looking for, and also hopefully a very simple trend trading strategy. So we've got about 10 minutes left for Q&A. Please do let me know if you've got any further questions. I can see a few have come in. As always, I'm going to repeat that if you could please stay on the call to complete a short survey after the session is finished, just again so that we can tailor some of these future sessions for you and what you're looking for. That would be great. But also there's some information if you scan that QR code about how to sign up for a live account with VT Markets. Okay, so we've got 3 or 4 questions here. We've got Sudip, what if we use the volume with this strategy, and what about false breakout? So yeah, again, Sudip, I haven't included volume on this, but if you want to use volume as an indicator to confirm or as a confluence to your trading decision, that's absolutely fine. So to do that, if I just move back, what you'd want to see is sort of like the volume decreasing probably slightly as we come into here, as we compress. Then you want to see a spike in volume to push through a decrease in volume as we pull back, and then look for another increase in volume as you as we hit here to get your entry signal. Okay, but of course, again, I haven't used volume here, but volume is a tool that is very powerful for people to use in conjunction. I would say more so on sort of indices, commodities, and certainly stocks. Because volume data is much more reliable. In Forex, we get a lot more OTC stuff which the volume is not actually included. So, but certainly in stocks, it's a very, very useful tool. So what if price in the supply zone, which is tested 4 times, and after touching the 5th time, it goes down and starts to consolidate? What would my plan be on how to trade in this situation? Does price break back above and make new high, or goes to lower zones? So again, I think, we're going to talk about what I call disruption in another session. But if price breaks back down, okay, then you're no longer really looking for that trend trading strategy. Okay, you're not looking for that trend trading strategy at the moment. So again, this is why it's good to identify the price action to then start formulating your trade plan, rather than, because what too many people do is they see this and they start trying to jump into the trade. And what I'm trying to get across is that when we see this price action, that tells us that we want to start formulating the plan on how we're going to get in. Not we're just going to get in, we're going to start formulating a plan. So if price breaks down on that 5th test, well, then it's not doing what you wanted it to do to create a high probability trading setup to get long. So then you start thinking about, okay, well, it didn't do that. What would my next step be? Well, I need to look for another type of some more information from the market that it is going to break out, and then we can look at trend trading strategies again. Or it's communicating to us, which we're going to cover in another session, that it's going to start consolidating, maybe be a bit more range bound. So therefore, I'm going to start looking for a bit more sort of like trend reversal trading strategies. So I hope that's okay, Sudip. How do we handle a situation whereby price gets to the pending order of the major zones, and then price didn't hit the pending orders but starts going in a direction without hitting the pending orders? How do we handle such situations? Okay, so what I'm guessing you're meaning by there, Emmanuel, is like front running. So you had an order here. Say we had an order actually just below or just inside that zone, around this high here, or sort of like what's that would be 169.90 ish, and price only comes down to 169.96 and then moves off. You've got two choices really here. My personal choice, and the personal bit of advice that I would give people, especially if you're a new trader and a beginning trader, is you've missed the trade. Okay, you just have to move on to the next opportunity. There are so many opportunities in the markets. Okay, just because you miss one does not mean that it doesn't mean anything. Because basically, what happens, what you're sitting there saying is, okay, I missed that trade. How do I get in on that trade? Well, what you're doing by trying to get in on that trade as we move higher is you're trying to chase the trade. And what you're doing by doing that is, again, you're basing your trading decisions on an emotion of missing out on the trade. So it's an emotional decision. You're entering a trade up here. You're entering uh, less trades with less edge. You're entering trades, worse trades. So you're actually eroding your edge in the market. So you need to stick to your trading plan and just accept that you're going to miss some trades. I have it all the time. I have trades that I miss because it front runs. I've missed countless trades because of spread, where the market's actually hit my level, but due to the spread on it, I have missed the trade. Okay, but I don't go chasing, I just leave it. I've missed trades because they haven't executed within my normal trading time parameters. Okay, but you just move on because there are going to be more trades. Okay, and there are going to be more opportunities. The other one would be to look for, if we start trending up here, then you can use this by moving down a time frame and start looking for those sort of continuation trades that we just spoke about, where we're looking for lower time frame trends to pull back to the moving averages to get in. But like I say, by doing that, you've got a clear parameters on where your entry and stop should be, and you know that you're going with the trend. But personally, like I say, especially if you're a beginner, I would learn to accept that you've missed trades, because that is a much better skill to develop, the patience, rather than going chasing the trades. Okay, so we kindly put in the link there to register for the next session. If you could please go and register for that, that would be great. It would be great to see. I know that I can see there's plenty of repeat people that come along to these sessions. So if you would like to come to the next one, please register for the next session as well. That would be great. For the ATR indicator on TradingView, do I need to change anything in the setting to get the same setup like yours for MT5 from the previous session? No, just the standard sort of 14 period, just the standard 80. Again, remember we're just using these as guides, everyone. Okay, so they're not. It's not like a hard and fast. It's not like a statistical certainty. It's just using it as a guideline to make some decisions. So yeah, just adding the indicator on there will with the standard settings is absolutely fine. London pre-market depends which way you look at it, really. So often people say the pre-market session from London starts around 7 a.m., but the actual futures for the FTSE and stuff opens at 1 a.m. UK. Those are UK times. Okay, so you've got London open at 8 a.m. People often sit there and say the London, like, when London starts to wake up and the Asian session finishes and the sort of like London session starts to wake up, it's around 7 a.m. But you've got that overnight session which starts in the futures from 1 a.m., which is sort of like in the Asian session. Okay, I heard if we miss the opportunity, we need to wait for a retracement because big institutions use retracements to cover the initial loss before distribution. Yeah, and again, so you know, if price comes down here and starts to move up here, there's nothing to sit there and say that it doesn't come back into this area and then have the distribution phase. So again, that's another reason why a lot of traders do sort of like make that emotional decision. They get caught out because they just start seeing it moving away, and they jump into the trades. But that's not in this scenario, it doesn't do it. But again, often it misses, moves up, then comes back deeper, triggers you into the trade, and then moves on. So if you start trying to jump into the trade here, you can take one or two losses in here trying to force the trade, when actually if you just exercise the patience and waited for it, it would pull back and connect with you anyway. So yes, again, that's another reason why it's vitally important to be patient and disciplined. And like I say, there are going to be instances where you're going to get this sort of movement where it doesn't pull back, but often again it can still do that. Okay, cool. Great stuff. Everyone has lost there we go. Any last questions? We've got 2 minutes. How big institutes? How is leverage works? I'm a newbie in trading. Okay, Gerardo, we're actually going to cover some very sort of like basic trading principles in another session. Again, going to try and keep these. I appreciate that there's questions that come out of these and stuff, but we're going to try and keep the questions as specific to the topic as possible, because like I say, a lot of this stuff, there's still so much stuff that we can cover in the trading book. So please do keep coming to the sessions, and we will cover a lot of these questions that you have in future sessions as well. Um, is it important to use order flows for entries? How do you mean by order flows? Do you mean sort of like order blocks, Hugo? I personally use support and resistance, which is identifying the order flow in the market, which so I think vitally important. Like if you can identify institutional order flow, then that'd be great. And volume footprint we can cover in another session as well. So like I say, guys, I think we're actually at the end of the session here. So, but please do stay on, answer that short survey. It will literally take a couple of minutes, and yeah, please let us know what you'd like to see covered, and we can make sure that gets covered in future sessions. Right, okay, everyone. Thank you so much for joining us. I hope you have a lovely day, and I look forward to seeing you all on the next session of the Trading Vault.